Well, let me welcome on board PN Vasudevan, the MD and CEO at Equitas Small Finance Bank, and chat about, how their business has been. Mr. Vasudevan, good to have you on ET now. Thank you so much for taking the time out. I want to talk about your asset quality firstly, because last quarter we saw your NPAs did deteriorate. Tell me what the picture is looking like right now, because it was partially attributed also to the Tamil Nadu floods. So in that sense, it was a one-off.
Yeah, good morning. So our third quarter, our NPA had moved up from 2.21 to 2.39. There was two factors. One is that we did a securitization transaction in the third quarter. Actually, we have done a securitization for the first time since becoming a bank. And so when we do a securitization, part of the asset moves out of the system, and that has an impact on the NPA. So if you adjust for the securitization, our NPA would have moved from 2.12 to 2.29 instead of 39. So by and large, the NPA is fairly under control. And, third quarter typically for us is a seasonally weak quarter from collections because most of South India, we get the heaviest rains during the third quarter, and that does have an effect on collections. Last year, third quarter, we had a 5% gross slippage, whereas this year, third quarter, we had a 4% gross slippage. So it's slightly improved over the previous year, same quarter. But as I said, if you adjust for the securitized book that we did, by and large, I think we are very comfortable. Our pre-COVID GNPA used to be in the range of 2.5%. And I think we are fairly back to our pre-COVID level after the 2 years of COVID impact.
Why were slippages so high? And do you think some of the slippages could actually reverse also?
Yeah. See, now what happens is because of the rains, as I mentioned, the slippage does tend to increase in the third quarter of every year because of the heavy rains we get in Tamil Nadu and parts of Andhra, Karnataka, etc. Normally it reverses back. I mean, fourth quarter, generally our slippages are very comfortable in the fourth quarter, which is what we have seen traditionally. So this year we'll have to see how it goes. But normally, yes, most of them do get reversed because when the customers come back to normalcy, the repayment starts coming back again.
Okay, fair enough. Let's also talk about your net interest margins and due to the rise in the cost of funds as well, we've seen a little bit of a compression here. What is the outlook in terms of the trajectory? Are you planning to reduce the cost of liability?
So yes, last year, that is 22-23, we had a 9% NIM for the full year. But this year, we have guided earlier also that this year the full year NIM should be in the range of around 8.5%, down from 9% of the previous year. And we have guided that our exit NIM for the fourth quarter should be somewhere in the range of 8.25%. So third quarter, if you see, our NIM was 8.36%. So there should be a further drop in that in the fourth quarter, largely because our interest cost has been going up. It's actually gone up by about 1% over the last 12 months. And so that is an impact on the NIM. But what we must know is that, in Equitas Bank, almost 85% of our loans are fixed rate loans. And so last year when the rates have been going up, we have actually had the worst of the times from the NIM's perspective. Hopefully, if the rates kind of stabilize, if not go down, at least stabilize, I think our NIM should be fairly comfortable going forward.
So contingent on a lot of factors as well. And, looking at your overall housing finance book as well, that's up from 7% in Q3 to 10% plus AUM in the current quarter. Is this a strategic move to increase the share of housing finance in AUM?
Yeah, so if you look at our loan portfolio, the largest portfolio contribution is coming from small business loans, which are secured against the house property of the borrower. That's about 38%. And the second largest contributor is vehicle finance, commercial vehicle largely, with a little bit of used cars, which is about 25%. And the third largest contributor is microfinance, which is about 19%. Our fourth largest contributor is the housing finance, affordable housing finance. We started affordable housing finance sometime about 3 years back, and that's been touchwood coming along quite well. And yes, we have been able to grow that fairly well. So basically what's happening is that our unsecured book is coming down proportionately, while the housing finance book should be going up to that extent.
At this rate, when do you really require capital?
So we are fairly comfortable. Our capital adequacy is over 21% at this point in time. So we are fairly comfortable on capital. We don't have much of tier two. So there's a planning that, sometime down the line, when we need additional capital, we would look at the option of tier two to the extent possible. So I think raising equity capital is sometime down the line.
Okay, fair enough. And where is it, your outlook in terms of, the overall interest rate scenario? Because that is not really looking favorable for the bank given the high rate of fixed rate loans. As we're going forward, are there any expectations of rate cuts? Do you think that at least is desired? A 2.25% ROA, would that be achievable for FY25?
So we have not guided a 2.25 for FY25. All we are saying is that a model like ours should ideally produce an ROA in that range, is what we are saying. We are not really guiding in terms of the timeline by which we should be able to do that. But coming back to the interest rate scenario, yes, you are right. The general expectation is that the rates are likely to remain where they are for some time to come, and maybe 2 quarters from now or maybe 3 quarters from now, assuming that the inflation does come down, it's possible there may be a drop in the interest rates. But from our side, as a bank, we are quite well placed even at the current interest rate scenario. And as I mentioned earlier, if the interest rates even hold steady without necessarily dropping, I think our NIM should be fairly comfortably placed. And as I said, 85% fixed rate loan gives us a positive impact in this scenario compared to the negative impact we had over the last 12 months.
I would like to draw your attention to the fee-based income of the bank. Given the fact that right now you're a small finance bank, do you think that in a sense becomes an impediment for you to grow?
The fee-based income is about 1.85% or so, in that range of that. And I think that's a very comfortable level. Basically, our fee income is contributed by our loans, where we get the processing fee income. From the liability side, we get fee income from distribution of third-party products, and also we get fee income from transactions. So these are the three large contributors of fee income. And I think 1.8 to 1.85% contribution from fee income, I think, compares very favorably with other banks. Being a small finance bank and fee income, I don't think are really connected in any way. So the one thing that we don't have a contribution as of now is our AD1, the fee income from our foreign exchange transactions, because we just got the license from RBI recently, and the work is on in terms of launching products under the AD1 category license. So that as and when we are able to roll that out, of course, that will add further to the fee income. But otherwise, minus that, I think ours is fairly comfortable at this point in time.
I really appreciate your time. So glad you could join us with your valuable, inputs.